So today was Friday, very uneventful day as far as my progress with a 150K account, only $200 in profit. This is where I am after day 5, so about 1/3 of the way there. But I did want to take the time to show you the signals for today, and I wanted to kind of show you what does it look like when energy is shifted from a lower time frame to a higher time frame. So all the trades that I take in this 150K valuation account come only from the Intraday Trade Levels channel. These are actual buy and sell prices, and I follow this to qualify for the 150K account. Now today there were just two signals, one in the YM, one in crude oil. Let's take a look at YM first. So in the Dow, it was a buy at 155 or a sell at 90. So it was around 7:10 a.m. So we're just waiting, nothing happens. Came close to triggering long, but no, not quite 155. And then of course the news. Now the news drove price from 90 about 70 ticks lower, but of course no one is trading the news. I get it, I understand. Let's move on. So after the news, close to 9 o'clock, this was the first trigger on the long side at 155, and at first only about 20 ticks here on this move from 155 to 175, 176. Now again, as I've been saying, these signals are based off of a fairly small time frame. At least for me, this is a small time frame that I am using to generate these signals. The issue with a small time frame is that the energy is limited. What does that mean? Price cannot really get away too far from the trigger, right? So what you see is price breaking through and coming back, price breaking through and coming back until there is a shift from the lower time frame to a higher time frame. So this is at first, right, 20 ticks right down. Now again, as I say, do these triggers continue to be valid after they're triggered? Yes. These triggers continue to be valid, but each time they get triggered, the probability of success is slightly lower. It's important to keep it in mind. If you cannot catch the first one, what you want to do is look back on the chart, and you can see when I post these signals, the time is right over here, and then look on the chart and see how many times they were triggered already, just so you have an idea. So the triggers remain valid, but maybe they would drop from 75%, let's say, success rate to somewhat lower. Still well over 50, but maybe not quite 75. So to me, once price breaks, for a trade to be valid again, price needs to kind of get reset. The trade needs to get reset. How does that happen? In the case of a long, price needs to get below the trigger. To me, this here is not enough. That's about 11 ticks. On a YM, 11 ticks is not enough. In a S&P, it would be. Even in crude oil, it would be, but not in a YM. 11 ticks is not enough, so I would not be taking this long. However, this is a nice reset over here. That's about 30 plus ticks below the trigger. This is good enough, okay? So price again comes back and you have another long, and this time it's good for around about 70 ticks or so, a bit more than 70 ticks. The thing is though, there is still, even though there is a nice move up, there is still no shift of energy to a higher time frame. What does that probably mean? It probably means price will come back again to the trigger. Here we are, okay? So even though it was there was an attempt for energy to get shifted, but not quite, and it comes back. Is this a valid reset? Yes, it is. So if now we have a long, it is a valid long trade. So price breaks through, and this time gives you about 15 ticks. So not much. You have about 15 ticks on this go. Again, the energy still remains in a lower time frame, not going anywhere, right back. And now it breaks. Now I know this is now a bit more advanced, but I mean, those of you who have been trading a while, you guys will recognize this. Here is a low, right? Here is another low broken by about a tick, right? Here is a third low, and look at this wick. They drive it down. What are they doing? They know where the stops are, or those people who try to go long. Their stops would be right below these pivots, right on top of or slightly below these pivots. So what do? They break it. They collect all these contracts. All these people who are long get stopped out. They collect all these contracts, and now there is a shift to the higher time frame, and very quickly, within just a few minutes, you get about 100 ticks on this move. But that's not all yet. That's not all. It continues. It goes 200 ticks above the trigger, and eventually the YM gets to 300 ticks plus above the trigger. Here it is. So that's what happens when there is a shift in energy from a lower time frame to a higher time frame. However, we have no way of knowing when this will happen, right? So here is the trigger. I mean, all the way down there. I don't know when this shift will occur, and that's why I say these signals are designed to be for scalping purposes. And very often I get comments in my Discord channel, but wow, when they run, they're such great moves, and you keep saying it's scalping. Yes, because after the fact, it's very nice to look and say, look how far price has gone. In real time, you don't know when this will happen. And in the meantime, what? You're going to be up a whole bunch of money, and then all of a sudden you're back to break even. So, I recommend you use these signals as a scalping trade. However, yes, the potential is there for it to be much more than just a scalping trade. And by the way, can we expect this move every day on a given instrument? Absolutely not. It all depends to what time frame the energy was shifted. To a 60-minute, to 120-minute, to 240-minute, to a daily. It all depends on that. Sometimes a shift is just to a higher time frame that's not very big in size, and so the move is not going to be as great as this. It will still be a nice move, but not quite as great as this. So I just wanted to kind of point out why I say, try to keep it as a scalping trade, because in real time you simply don't know. Now imagine yourself being long, let's say from the 155 trigger to around 230, let's say, and then all the way back down to break even. This not only could it be frustrating, but it can hurt you if you have a trailing drawdown, right? So that's what I'm saying. Just what I've done today is I simply took the 20 ticks in the YM, and that was one of my trades. Let's take a look at the second signal, which is crude oil. So crude oil, the second signal, at 9:35. I posted a sell at 83.12. The buy side never triggered. So 83.12 at 9:35. Price is here, slightly above the trigger. Very quickly gets triggered, and very quickly gives you nice 20 plus ticks on this trade. So again, these signals are designed to be scalping signals, right, for scalping trades. For me, I took my 10 ticks. I was done. It was Friday. I wanted to be done. I took the 10 ticks. I was done. There was more than 20 available. But again, remember, right, this is from a lower time frame still. So what are you expecting? Price to come back. And price indeed comes back to the trigger. Another thing I say, right, the first trigger is the best. After that, probability does go somewhat lower for success. And actually, I think in crude we see that. Here is a touch of 12. Look at that. Here is a touch of 12. Low, 12. 83.12 to the tick and an immediate bounce. Now, I mean, the bounce is about 30 ticks. You know, my stop would have been above this pivot, but that's very individual. I can see you saying 30 ticks is too much for me. All right, if that's the case, you would have gotten stopped, but price just comes back. Again, understand, it's just the energy stays in the lower time frame, so this will happen. You see, another touch of 12 and a bounce again, and then it breaks 12, but there was no shift, price comes right back. So this becomes very frustrating. It could become very frustrating, and that's why I say the first trigger is the best. You take your money and you are done. You don't have to put yourself through this. I was very happy I did not put myself through this, because in real time this is very frustrating, right? Breaks through, just kind of going nowhere, breaks through, comes back. So again, there is no shift yet to a higher time frame, and so price just stays here. Breaks through, reloads, and now it breaks. So finally, after 1140, there is a break. Now, eventually, this break ends up being 100 ticks in the money, with bounces, of course. But eventually, by the time the crude oil session is done, price goes down and pretty much makes, a full dollar. The low is 82.14 from 83.12, so close to a full dollar, $1,000 per contract move. But you had to wait for this shift over quite a while, right? And in the meantime, you had to experience this nonsense, and it's difficult in real time to put up with this, because you don't know that this is coming, right? I mean, if I can squeeze it a little, you can see. Look at this, right? Just nothing right around the trigger until finally there is a shift to a higher time frame, and then there is just a nice move in a direction of the trigger. But who wants to put up with like 3 hours of just a lot of back and forth? So again, just wanted to kind of show what happens when price stays in a lower time frame, and why I say first trigger is the best, and then price will probably come back. It is fairly rare that right kind of out of the gate there is an immediate shift. It does happen, of course, but it's more rare. For the most part, you see this kind of deal, and it could obviously be frustrating. Okay, so I'm doing well overall. 5 days of evaluation. I'm up about a third of the way there. I'm going to continue next week. So please leave a like and subscribe, and please share these videos. Maybe there are other people who can benefit. That would be great. Thank you all. Talk to you next week.